Assalamu alaikum. Good afternoon, everyone. Would you please confirm I'm audible? Please let me know if anybody have any question from the previous sessions. Before starting today session, let me know if anybody have the question from the previous session. Yes, please share if you have the question, please share in the chat or let me know. I'll unmute. I think let's take another couple of minutes. So due to maybe the prayer, some people are not yet online, but normally I appreciate if the people join on time. And secondly, in the Zoom, you register your name. It will be the same name that you wanna get on the certificate. So I appreciate if you register your appropriate name, because I'm just gonna, we are taking the attendance in multiple ways. So I'm just share the screen and getting the attendance also. Today, our topic is the exempt income. Exempt income, Article 22 of the City Law. Total were the 4 exempt income. 2 we already learned in the previous 2 session. So now the balance 2 we will learn today. And here I write up some, the red text and the question. So what is the benefit for you guys to learn the today topic? What is the benefit or what is the learning in the today topic that you guys will take up? So here's under the participation exemption, foreign permanent establishment exemption. So we will use the FPEE for this, the abbreviation for the, or we will use the permanent establishment PE. But the today topic will be the foreign permanent establishment exemption. So today we will see in the corporate tax return, what is the election option is available. If it is available, so under which scenario it will be good for you. Scenario, it will be good to opt for the this. Under which scenario it may be not good for the organization to opt for that. Okay, so let's start the topic. Today is March 9, and I believe our today is the day is 13 or 14. If anybody want to confirm, so we can write up that day also. Anybody would please confirm today is our third day is 13 or 12. Here we are inviting on the topic base some of the guests if they want to join the topic base, so they can join, but they will not be entitled for the complete course certification that we already committed. But in case of any new guests they want to join, they can join on the topic base. So in this regard, so this topic will cover the corporate tax return, the appropriate the section. So that section I'm gonna share with you. Okay, so corporate tax we have to learn today. We are gonna learn today the election, whether election is available. If it is available, under which scenario this is good for the your business, means the organization who's gonna file the return, they have to assess whether this election is good for that organization or not. I'm not saying in a journal, I'm saying it scenario based. Learn in which scenario election is good or not for your business, the organization that you're gonna file the return. So this is the our today main point. So the second, in which scenario election is not for you, not good for you, your business. Okay. So that we're gonna see that. So next, learn it is revocable or irrevocable. What does that mean? Irrevocable, that is a lifetime. Normally, we, for our understanding, we're saying one time, lifetime. We can say we make in future, we cannot change. And the revocable mean every year we can make the election. So now we will learn whether this election is we can make every year or we cannot make every year. What is the election? Foreign permanent establishment exemption. We are talking about the foreign permanent establishment exemption. This is our topic today. So learn, can we add laws making foreign permanent establishment exemption into UAE corporate tax? Here, for our understanding, we might use the word branch because the foreign branches. Commonly, we are familiar with the branches. Okay, normally everybody knows the branch is the extension of the parent company or the main company. Branches do not have separate legal entity. So now, in terms of the PE, the permanent establishment, the definition is broader. Definition is broader. There is many other scenario may fall under the PE, permanent establishment. But just for our understanding, we are using the branches because apart from the branches, you may have the other type of the presence in the other country. You may have the agency PE, you have the branches, you have the service PE, you have the property. There are many things that we will learn in the PE topic, but here just we have to learn the exemption, foreign permanent establishment exemption. Now next, learn, can we opt not to add profit making branches? Okay, here this last 2 points is referring, can we have the choice? Can we have the choice? We can choose based on our wish list. Maybe we will based on our liking and disliking. So this is the point that we are going to learn that. So now the topic, foreign permanent establishment exemption. So under that, what is the first point? Foreign branches applied for the exemption election. A UAE company is having branches in foreign country. The previous one, I just give the some quiz to highlight in your mind. So what is the key point? The first 4 or 5 points are the key element that you should think during this session are the what you need for your business or for your client business for whom you are giving the services as a consultant, as a advisory, as a profession, whatever the format you are working. These quiz must be in your mind while going through today topic. So foreign permanent establishment exemption, Article 24 of the City Law, foreign permanent establishment. So exemption, UAE companies having branches in foreign country, yes. Okay. So do not take their profit and losses into consideration. Okay, so let's see. Election made for all branches, selection is not available means choose some branches, some of the branches. Okay, so what we are saying that election for all the branches, either for all or either for none. We do not have the option to take only on our choice basis. If we are going to make the election, we have to make for all the branches. Now the next election made, then no foreign tax credit relief. These are the topic that we're gonna discuss today. Next is the non-resident person. This is our second topic today, non-resident person having the international transportation in UAE. Here, the important part is a non-resident person having international transportation in the UAE. Means the non-resident person who have the transportation in the UAE, they are exempt from the UAE taxation. How it will be exempt? What are the conditions? We will discuss this. Here, the main principle of reciprocity we discussed in the previous session. Now, the next topic is the related party and the connected person. Again, here also we're gonna see that how to record in the city return, what are the transfer pricing effect. We are not gonna discuss today the transfer pricing topic itself, but under related party, there will be some adjustment that we have to record in the corporate tax return. So under which section we will record. So what are the effect in the corporate tax return and what are the learning today we have. So we're gonna start today. Let's dive today. So I took this election for foreign permanent establishment income from the corporate tax return under the election. So this is the election number 16, maybe plus and minus, but in term of the sequence, this is the 16th election that we have it. Now the first question will be appearing in the same fashion. Does the taxable person have any foreign permanent establishment? Why this question is available? If some organization, they might do not have any operation outside UAE, they can choose only no. For them, so this whole written further subsection of this section will be not open. If you made the foreign permanent establishment exemption, if you do not have any branches, you do not have any P in the foreign countries, so just opt for the no. Then if you are opting for no, then all this conversation that we're going to discuss today, this will not apply to that business. But if the entity you have the foreign permanent establishment, then we have to say yes. And the further implication while opting the, we will say yes, we have the foreign permanent establishment election. Then we will see what are the further question will be open. Now, if we say yes, okay, here is another point. If maybe the first tax year you do not have any foreign permanent establishment, you can opt for the no. But in the second year or the third year, and then going forward, any time if you have the foreign permanent establishment, you can opt for the yes. Then you can choose for the yes. Okay. Here the option, one debate is there. This is the revocable and irrevocable. Many people have different views in the market, but I'll give you the reference also, but this is the not revocable. Mean it is a revocable. Every year you can make the election. Okay, in the city law, we did not see any guideline and any specific point where they mention it is a irrevocable. Where they mention it is a irrevocable, we did not see any point. So which means every year you can choose this election, yes or no, means you can opt for the election or not for the election. Anyhow, in future year, if you have the establishment, then you can opt for the yes. Then if you opt for the yes, then here you have to make the election now. Would the taxable person like to make an election to exempt both income and expenditure? Income and expenditure of foreign permanent establishment? Income and expenditure of foreign permanent establishment. Here, the word income and expenditure for foreign permanent establishment. The word income and expenditure both in throughout the return. And throughout the return, mostly the tax authority, they are discussing the income and expenditure also because that is relevant in certain area that where the adjustment is made and to be expected in the future. So they will ask this that expect to be reported in the city return. Now here, if we say yes or no, okay. So which means even because there is the 90% are approximate, the most of the elections are irrevocable. Apart from the couple of elections that one of the free zone, qualifying free zone, that is the after 5 years you can again make the election. And second is this, that we cannot see that today. Okay, foreign permanent establishment election, that it is also irrevocable, that every year you can make, but the free zone is a 5 year. So this impact will remain there. How it will be impacted, let's see. To eliminate or reduce the potential international double taxation. Here, now we are going to understand why this option is there. Why this option is there? Why they said this election you can make. So here the main point, they said to reduce or eliminate potential international double taxation. Maybe you paid already tax in the foreign countries. Okay. So you will not pay the tax in the UAE. If you paid in foreign country and you're receiving the profit, so then you will not pay here in UAE. A resident person can make an election when determining its taxable income to have income derived from foreign permanent establishment exempt from the corporate tax in the UAE. Taxable person can make the election when determining is the taxable income to have in UAE. Here in the UAE means the UAE company deriving from the foreign source income. Okay, in case of deciding to exclude the income and expenses and losses of the foreign permanent establishment from the calculation of taxable income, the election will only apply to the resident person, foreign permanent establishment which are subject to corporate tax on a tax of a similar category at a rate of not less than 9%. The subject tax requirement here, resident from the foreign source of income. On the meanwhile, you can opt only if the foreign country where the tax is 9% or more than 9%. In that scenario, only you can opt for this. If let's say the foreign country tax is a 5%, then you cannot opt for this election. Which means this election means for that foreign permanent establishment, maybe the company have more than one establishment or more than one branches in the foreign country. Only the country where the tax is less than 9%, only that country you cannot take into exemption calculation. Other branches, yes, if we are saying we cannot, means you have to incorporate in UAE tax city competition. Income also and the expenditure also in the UAE city competition, wherever the tax is less than 5%, because law is saying yes, you can make the election, but he's saying that election will not cover the tax jurisdiction where less than 9%. Hope this point is understood. Now the election must apply to foreign permanent establishment that meet the subject tax requirement. A resident person may not elect to apply exemption for specific permanent establishment exemption that we already discussed, and it's irrevocable. Now we're gonna see that the same topic in written, we will see where we need this information. So in terms of the exempt income, we have the four exempt income: dividend income, participating income that we already discussed, the foreign permanent establishment exemption that we're gonna discuss today. Okay, and okay, guys, quickly confirm my voice is fine. Quickly, guys, please confirm my voice is fine. People are saying there is a voice distortion. Voice distortion. Okay, guys. Okay, that may be one reason or due to some other factors. Okay, now let's continue the today topic. Okay. Okay, now today we're going to discuss the foreign permanent establishment exemption, and then we will continue the international transport. Let's continue. Here I put some marks because total is the 4 and how much we covered, 2 we covered, 2 we gonna cover today. Now let's go to the today further. Now here the important concept we have to take, that is the foreign permanent establishment exemption. In which scenario this concept will be applicable, and in which scenario I already use the word branches, but let's understand in an appropriate way. So in which scenario this will be applicable and which we're gonna take the advantage of that. Okay. Local branches, extension of the business. Okay, the local branches so that fall under the FPE, foreign permanent establishment exemption. Please confirm quickly the local branches can be fall under the participation exemption criteria, or they will subject to foreign permanent establishment exemption criteria. Quickly, guys, quickly respond on that. I appreciate your presence. How about the local branches? The company who have a UE-based company, UE-based the taxable person, he have the branches in the UE in different emirates. He have the branches in the different emirates. So whether this will be, they will be fall under the foreign permanent establishment exemption criteria or no. Okay, because UE is the local, so it's already in the extension of branches or the extension of the business. So they will not fall under. So let's see the profit and loss of the UE branches. Profit and loss of the UE branches, both will be taken into consideration for UE city competition. The foreign permanent establishment exemption. If we are using the foreign permanent establishment exemption, here we are using the foreign permanent establishment exemption. Okay, the foreign permanent establishment exemption, both local branches will not be under this exemption criteria because the title itself is saying foreign permanent establishment exemption for the branches. So both will be part of the city competition inside UE. Here, so they are considered a single entity. Now we have to see the foreign branches. The foreign branches, whether election is made or no. So first we have to see the eligibility condition. If election is made or no, while we checking the election is made or no, first we have to see the eligibility condition. What are the eligibility condition? Foreign country, the corporate tax is equal or more than 9%. Then we can make the election to exclude from the UE city. This is the one of the important part. This is one of the important part. Guys, hope you understand this point. I did not see any response from you guys. Quickly reply in the chat. You are with me. You are understanding that point. Okay, so now the one important concept that we understand, the 9%. If yes, we can make the election, but even we are making the election, what is the election? Election means we are excluding the foreign income and the expenditure from US city competition. The election means if we are making the election, we do not want to pay the tax in the UE. So this is election means. Here the saying the countries or the branches in the country where the tax is 9% or more, even you make the election that you will keep outside. That will not be UE subject to UE taxation. But the branch where the taxation, the country taxation is less than 9%, that by you cannot exclude. You cannot exclude. Even you made the election or even you not made the election, that will remain the UE city competition. That will remain the UE city competition. And how it will be recorded, that we're gonna learn today. Now here we're gonna see that election. Yes, if we made the election, then then we ignore profit and losses of the foreign branches subject to the condition. If we not made the election, we will includes means in UE city competition, profit and losses taken into UE city competition. Now the next, the foreign investment. Okay, let's take the understanding. Here we took the branch and here we will see the foreign investment. Here the foreign branches, under the take into account the profit and losses of the foreign branches. Here we already understand this concept, but now here we understand the concept of the branches. But here now we're going to understand the foreign investment. As under foreign investment, might be we may open the branches, or might be we open the subsidiary also. Okay, foreign branches, this is the concept, but here the another concept, foreign investment. Okay, so now the foreign permanent establishment exemption is available. Okay, going to apply Article 24 of the city law. Here further detail that you gonna understand, that you may read the Article 24 of the city law. Here you will have the understanding, but in term of reading, yes, you go, everyone go and read that also. But even if you not willing to spend more time, at least ensure this learning, that through this training you are going, emphasize on that, document on that. This will cover more than 90%. Okay, maybe the 10%, the points based on reading, you may understand better, but we are more than 90%. You are covering the each topic in this training. Okay, now going to apply. Yes, the same concept. Ignore profit and losses of the foreign branches. No foreign tax credit relief, as the income is not coming, so relief will not become. Okay, no. So which means profit and losses and foreign tax credit will be fall under the UECT computation. So how we gonna do that? The foreign tax double DTR is a double taxation relief. Double taxation relief. So FTCR, foreign tax credit relief. Okay, so now we have to see. We already taken the profit and losses of the foreign branches. Now we have to work on the foreign tax credit relief, and how we will do that? Double taxation relief. Lower off. Okay, what the lower off means? If you paid the more tax in the foreign country, in UAE they will not give you the refund. UAE will not give you the refund. UAE will say, okay, lower off whatever the you are taxable in UAE, up to that amount you can get the relief. But in case you paid the less tax in the foreign country, let's say the foreign tax is a 5%, and here you are calculating that. So they will say, okay, now UAE tax is a 9%, the balance 4% you have to pay. Balance you have to pay in the UAE, and 5% you will get the claim over as a double foreign tax credit relief. We're gonna do some exercise also, so you guys learn over there also. As a foreign permanent establishment, as a foreign investment, we understand the foreign branches and the foreign subsidiary. Subsidiary will give us the dividend income or capital gain. So this we already covered in the exempt income too. The second exempt income we already discussed this topic. Article 23 of the city law. So here the another concept, just for our understanding, most of the people are familiar with that. Branches will never give you the dividend. They will give profit and loss. And subsidiary will never give you the profit and loss. They will give you dividend. Guys, quickly, please confirm you guys understand this point. You guys understand this point? Is there any point that you're gonna look into further understanding? But for sure, during the exercise, you will understand more. I appreciate all the participants to quickly yes or no, whatever the, even you understand, I appreciate to reply. I'm just seeing your activeness in the session also. And secondly, the most of the people are familiar by name also. Thank you guys. Let's see the next. Here, the last one we discussed, the foreign tax credit relief. How we gonna opt the foreign tax credit relief? Here, the high level illustration purpose I added over here. Even the most of the people, they are learning the taxation as a theoretical part. Maybe they are not well enough in the foreign tax credit relief, how to apply over there. Or even in terms of the theoretical, they might be aware, but they might not aware the financial impact, how it will be financial impact. Okay. So I'll give you the overview also today, and you will understand the main point also while doing the calculation, what the factor that you have to consider. Okay. Here I put some figures as a understanding purpose. So this is, we are saying the taxable income 120,000. So here the next tax liability, we will calculate the UE taxation. Once the taxation is calculated, okay. So this, see, this figures may be not correct. Okay, this is I put just for the calculation purpose. So here we are seeing the final tax liability is a 9900. It will be 99,000 or 100. So now if you calculate the 9%, if you calculate the 9% of the 1110, so if you calculate the 9% of 1110, so your final tax liability will be available over here. The figures are not correct. So now here what we have to do? First, we have to see the UE tax, final UE tax liability. Once we have the computation of this amount, then we will go for the effective tax rate. Effective tax rate. What is the UE tax rate? Okay, so we have to calculate the UE effective tax rate. What does that mean? Because there is a one slab of 375,000 that is a zero rated. So our total income is 110, but our final tax liability is 99,000. So would you guys quickly calculate, is coming 8.25 or is it differ? Would you please guys calculate, this is the same or it is a different? What is the effective tax what is the effective tax rate in the UAE? UAE corporate tax is 9%, but the effective rate is not 9%. It's less than 9%. That may vary entity to entity, but it's not 9% that actually you gonna pay. Effective means that how much the tax rate that will be paid by the entity. Guys, it is the 8.25 or is it different? Guys, please, are you there? Guys, are you there? Okay, now the next point that we understand before also, and today I'm just highlighting foreign cross-border transaction with the any country. I just put the name of Indonesia. I explained also maybe in the last step-by-step foreign tax calculation. Okay, step one: determine foreign tax income and the taxes paid. Okay, identify the total taxable income earned in the foreign country that you will have from the that. Then determine the foreign tax paid on that income, because you paid in the foreign country and you must have some supporting document. You paid the tax in the foreign country. Okay, so if you paid in the foreign country, that you must keep all the commercial and the supporting document to support that and you must have the certificate from the local authorities that this amount is received under your name, maybe through the another one of the representative or the in term of the withholding tax, another counter partner that you have in the foreign country. He will submit there and he will give you the documentation for the same. Now there's some jurisdiction they're saying the tax paid certificate also. So each jurisdiction they will have some sort of document. So this first step you have to arrange that. The second, calculate the domestic tax on the foreign income. Here the domestic tax on the foreign income. Apply the domestic tax rate to the foreign income to determine the domestic tax liability on that income that we are gonna calculate over here. We already calculated here the effective tax rate. Okay. Then the third step is the foreign tax credit relief is limited to the lesser of. Okay, what does that mean? The lower of below of them. Actual foreign tax paid, and second is the domestic tax liability on the foreign tax. We have to with the help of effective tax rate, we have to apply on the foreign income and calculate that. Then we have to see which one is the lower of, which one is the lower of. Okay. If we which one is the lower of, up to that amount we will get the foreign tax credit relief. Here is the foreign tax credit relief, the formula. apply, this is the formula, FTC foreign tax credit, then less than or equal to, okay, that we already seen here, foreign taxable income divided by total taxable income, okay, into total domestic tax liability. This is, we are gonna calculate that the foreign tax credit relief. Foreign tax credit relief, this is the formula to calculate. While doing the exercise, you may understand that, but here just for understanding, I added over here. So just as a illustration purpose, taxable income, taxable due on the taxable income, total tax due minus is the foreign tax relief into 9%. So here we gonna understand, that how much we pay tax. Here the same point, the how much the taxable for how much the UE tax on the foreign income and how much the foreign tax that you already paid, the lower of that you will minus as a relief from the, as a minus from the final tax liability, as a minus from the final tax liability, and then your city payable will be there. Here again, I just added in terms of the withholding tax, foreign tax credit for the tax paid in the foreign country. Here the withholding tax I added here because the in terms of withholding tax, you will pay in the foreign jurisdiction on revenue, on the transaction amount. Because withholding tax and the corporate tax both you are available for the foreign tax foreign tax credit relief. Both are available, but just imagine that in the foreign country that you paid the 5% of the transaction amount, and here in UAE you will pay the you are calculating the 9% of the foreign income, foreign taxable income. If you are calculating the taxable income, would you think it will be give you the some advantage? It will be give you some advantage because the 5% means the big amount that you already paid. And of the transaction amount. And here on the profit, maybe 20%, 30% of the profit. Take 9% of the 30%. Let's see. Again, the voice distortion. Guys, now why my voice changed to the Hi guys, please quickly confirm now why is fine. Okay, now I believe everything is working fine. Okay, any of the context relief we already discussed in very detail. So here the understanding purpose, we already have the previous session also, and the lower option, which one is lower, we will cover over there. Let's move to the topic. Save. Strange. Let me check. Guys, quickly, please confirm now it's fine or still the same. Hello. Hi guys, please confirm quickly. Hi guys, can quickly confirm voice is fine. Okay, let's start. This is the foreign tax credit illustration purpose that we see now. Our topic, the foreign taxable income in UAE for the resident taxable person, but exemption available. Okay, here the foreign taxable income in UAE for the resident taxable person, but the exemption available. Let's understand the taxable income in UAE. Taxable person in UAE. Now, the taxable person we have to see is a resident or non-resident. The first point, taxable person, resident. Resident taxable person, then what will be? This we have the next topic on the same tax, resident and non-resident, natural and small business relief. So you guys understand much better in that next session. That is very important. But here you will understand here also because you already covered the previous session. You already knows these things, so that no need to worry on that. Resident taxable person, worldwide income is taxable under UECT. So that most of we since beginning we are learning this part. So on the UE income, non-UE income. What is the worldwide income? Means UE income and non-UE income. Non-UE income relief will be available. So this is the non-UE income. This is the topic that we are discussing. This is the non-UE income. Okay. So if this is the non-UE income, so this is also subject to taxation in the UE, which means then relief is available to under double taxation. So now we will see what is the fixed permanent establishment exemption. The fixed permanent establishment exemption. So this is the topic we are discussing that. If this is that, then we have to see election is opt, election is made or no. If elected, if we made the election means we saying we will not pay the tax in UE on the foreign branches profit and losses, but subject to condition is meeting. Okay, profit of the foreign branches are not taxable in UAE. Okay, do not include gross amount in UAE city liability. So if we opt for the election, then we will not include the gross amount in the UAE city liability. And if we are not bringing the foreign tax, foreign income and the expenditure in the UAE, then there is no no DTR available. Today, I think I'm not sure what's wrong today. Uh, okay, guys, I just refreshed. So now, although I'm checking that parallel. Okay, now the same, now everything is resolved. Yeah, might be some internet. Okay, I'll do the needful before next session for this also. Okay, guys, now you can see the screen. Yeah, everything is fine. Okay, we'll do the next time this, Adnan, your request, because now if I'm gonna change that, it will be, I have to work on that. Okay, now is screen is fine. Okay, foreign taxable income, I'm gonna start again from the same. Let's see. Okay, the foreign income taxable in UAE. What is the mean? Foreign, if you have earning the some income from the outside UAE, that also taxable in UAE for the resident taxable person. Of course, the person who's UAE resident, if he's generating the income from outside UAE, is taxable, but exemption is available. So, but he have the double taxation relief as the exemption. So taxable person first, who's the we have to see the taxable person in the UAE from that perspective, which means the company is incorporated in the UAE. If the company is incorporated in UAE, they are the taxable person. There's a many other discussion also, which are the taxable companies. But as of now, just understand the UAE taxable company who's incorporated in the UAE is taxable. Then the person is a resident taxable person, is a resident or non-resident. So here the next point we have to understand, it is resident or non-resident. So if he is a resident taxable person, then he is subject to tax in UAE on the worldwide income. He is subject to tax in the UAE on their worldwide income. Worldwide income means the UAE income and non-UAE income. Worldwide income is under UAE city taxation, corporate tax. UAE income and the non-UAE income. Then if non-UAE income is taxable in UAE, so relief is available to under the double taxation relief. Now, next point we have to see the fixed permanent establishment exemption. Now, for fixed permanent establishment exemption, so we have to see the election is made or no. We have to see election is made or no. If we made the election, okay, the profit of the foreign branches are not taxable in the UAE. If the profit of the foreign branches is not taxable in the UAE, so what we will do? Because we opt for the election. Election means we will not pay the tax of on the foreign income in UAE, as we already paying the tax in the foreign jurisdiction, right? Profit of the foreign branches are not taxable in UAE. Foreign branches are not taxable in the UAE. So now they do not include the gross amount in UAE city liability. If we are not bringing the foreign income in UAE, so there will be no taxation also. Double taxation relief is available when you are bringing the foreign income in UAE, then you can opt for the foreign tax credit relief also. The second, if we not opted for the election, if we not selected the election, then gross income of the foreign branches will be included in the UAE city computation. UAE city computation. Then the double taxation relief will be available. Double taxation relief is available, then the tax credit exemption. So now the second point, the tax credit exemption, dividend, interest, royalty received included in UAE city income. Claim the double taxation relief. Claim the double taxation relief. How we will claim? This is the same point in previous slide. We already discussed how to claim the foreign tax credit relief. Lower of UAE tax on the foreign income and the foreign tax on the foreign income. Before coming this diagram, we already understand this topic. So now the next is the non-resident person. Non-resident person. Taxable person in UAE city. Yes. One who the company who's already established in the UAE. Second, non-resident person. Non-resident UAE income only. So which means the person who's outside UAE, who's not UAE resident, so he earning from UAE, if earning from UAE, so that also subject to taxation. How? Because they will have the P in UAE or nexus in the UAE. The definition of the P, the definition of P, we will understand that you operate in another country. You operate in another country. Maybe you send your employees from the UAE to another country. There is many conditions. I'm just giving you let's say we have the expo. Let's say the expo. So all the companies were involved in the expo construction, all the UAE base. No, many international companies also was in UAE for the expo project because they are here in the project basis and they have the custom duty exemption on the project basis. So which means on the project basis, you can go in any country and operate. Project basis, you go and operate. Mostly the public sector project, but as a private also, you will have the many options, you go and operate, right? So now, if you're gonna operate, maybe you have the agency P. The P concept is very detailed. We will understand in later on. And nexus. Okay, the nexus. Just for understanding nexus. Just for our the basic understanding. I'm just gonna give you the basic understanding. I'll give you the example. Let's say any company name. I'll give you the Roshan Real Estate. Roshan Real Estate is a Saudi company, with a very big name in the Saudi. I'm just giving you. This is the Saudi company. I'm just going to give you the example of the understanding for P and the nexus. Okay, so and their main business is the real estate. Here now the second is the let's say the Shah Rukh Khan or Amir Khan. Amir Khan, who's the Amir Khan? He is the one of the media person or the actor in the India. Amir Khan. So now the Amir Khan will have to. He's working as an actor, and he have the social media production house also. Production house also, right? So let's make another two classification over here. I'm just writing the production house, the media production house. If the media production house, now the second I'm just mentioning as a person. Person mean Amir Khan itself in nature, in his personal capacity. Personal capacity. So now if uh, the real Roshan real estate, they will buy one property. I'm just saying they will buy some property. Many projects UAE is going on. The EMR, many development projects are there, and many other developers are there. So let's take I'm taking the example of the EMR because mostly people are familiar with EMR. He taken one property from the EMR, and what he will do? He will taken the property and he will give on a rent, and he will generate the income. The same thing, the media production house also he will do the same property. Let's say the same project from the Imar, they also taken the property, and the Amir Khan media house, they also taken the property, and the as a person, as the Amir Khan, he also own the property. Guys, now is again today complaint is there. So I'm not sure today what's wrong. So now it's fine. Now it's fine. Guys, you other also people having this same voice issue, or only Miss Zubaira coming the same issue? Guys, audio is fine. To Hi, apology for the inconvenience. I think due to internet today we are facing the issue. Anyhow, I just reset. So hope today's session will be fine now. Okay, so let's now. I just want to quickly ask you guys. Everything is fine. The slide is there. Just quickly reply. I can see the screen. So we are here now. Okay, now before starting, we already understand, but what we're gonna discuss, we are discussing the PE concept. We have to understand what is the PE. So let's understand the PE. So guys, please confirm everything is fine now. Voice is clear. Quickly. Okay. So now we are gonna understand the word PE, permanent establishment. The permanent establishment we gonna understand in a first we said okay, there is a Roshan real estate. Roshan real estate. This is in KSA. And there's SIGA is the real estate. Means the property or rental, we can say, or the we here taking the understanding of the real estate. They are doing the construction, giving on rent and all these factors. So we just take the understanding. SIGA is a property. This is their core business. We all familiar with the SIGA. Now the second, we will see the concept of the Amir Khan. I'm just giving the same example that I started. So Amir Khan have the, who is Amir Khan in India? Is a actor. Okay, so now Amir Khan, we all knows he have the media house, media production. Even he don't have, so let's assume that he have the media production. Media production, he have his one company. I believe he have, but let's assume he have the, this is the company. Company mean juridical person, right? Now individual capacity. So now we will see the individual capacity. Here is the natural person. Right? Juridical company. So now, and media house, what is this SIGA of the media house? With the name of the, thank you guys writing the tick mark. So I'm not sure what is the objective to write this. The media house, the SIGA is to make the media production, like movies or whatever the entertainment media shows. So now if we see, and here we have the EMAR as a EMAR development. So I'm just taking the example of the EMAR for understanding. Let's say he also took the same project, even I'm considering everything remains same from the same project. He owned the property by the Roshan Real Estate, right? Then from the same project, this one, Media House. He also owned the property, and from same Amir Khan also have the property. Here he's in his natural capacity, personal capacity. Here his company owned, whose main activity is the media production. And here the Roshan Real Estate, whose main activity is the real estate, the property, the rental income or the leasing and subleasing, we will understand. So now, guys, this is a very main concept and critical point you guys have to focus over here. Roshan Real Estate, there's a SIGA, is a real estate property income. Amir Khan, he's the actor, and his media production house, as a juridical person, his main business is the media production. But he also owned the one property here as a investment. As an investment. So guys, now you may understand accounting standard IS 40, investment property under the investment, but here do not apply the concept so far. Just understand here is the main is the revenue generating scheme. This is the revenue. Because his main activity, he will make the revenue from here, but they will not make the revenue. For the media production house, they made, even they will make, but this is the investment purpose. This is not their core business. Okay. They have the property they are giving on the rental, but this is not their core business. And Amir Khan, he as a personal capacity, he owned the property. So once core income, this will be PE. They have their presence. They might buy directly under their name, or might through the open the one company here in the UAE. Either way, but once they own the property, they will be PE. And here now the nexus, another concept is the nexus. Okay, what is the nexus? So this concept I'm just covering in the same point. It will be frequently used. Now the nexus. So here is the the nexus. So nexus means in terms of the property, it will be a pair. But until unless you're not core-generating business, it's not your SIGA. But here is nothing. This will not be nexus, this will not be PE. This will be either under personal capacity. Under personal capacity, he can make the investment, he can take the rental income, and he can enjoy on that. This is his source. What is this? This is the source. UAE, for him, is a UAE source income. And on source is the withholding tax. And withholding tax currently is 0%. Currently, withholding tax is 0%. So now we have to understand the difference between PE and the nexus. The nexus means juridical person having the property in UAE, but that is not his core business. That is not his SIGA. If not SIGA, then is a nexus. If it's a SIGA, if a core income generating activity, then PE. Hope you understand this concept. if you one of the participants saying he's apply in his own company where he's working. So this is the P. In this is the P, but here for the same property for the Roshan real estate is a P. For the Amir Khan media production, this is the nexus. Okay. So then for individual capacity for Amir Khan, this will not be P, this will not be nexus as a natural person. So he will have the source. On the source, only the withholding tax, but currently withholding tax is a 0%. Okay. So guys, you have any point to ask over here? Let's move forward. We are already covered. So we are behind from our schedule today. One of the participants just make the tick mark. I appreciate if you can raise that. Okay. So now let's understand the theme. We already covered this slide. We already covered. Okay. Here we have the dividend income, double taxation. Now this is the point, non-resident person. So this is the non-resident person. We've seen the example how the non-resident person will have the income from the UE under the P, under the nexus, and under the natural capacity. UE income only, and having the P, if they have the P in UE or nexus, the word P or nexus. You got the if the juridical person have the property in the UE, here I'm using the word property, then it will be the either P is if cost income generating activity, then or if it's nexus, if this is not core income generating activity, but the property owned under the juridical person. So UE city registration is required. So UE city computation is applicable. Having UE source income, like the in personal capacity. In personal capacity, Amar Khan have the property. So no city registration, but withholding tax will be applied. Let's move to the next quickly. Now, foreign permanent establishment exemption, the same topic, foreign income. So here the foreign income received by UE resident, taxable person. UE resident, taxable person. So this is the foreign income who received UE received by UE resident, taxable person through a branch or overseas through a branch in overseas countries. Exemption election is available. That we understand that. Qasim Iqbal, please do not write on the screen. Please remove this. Guys, I appreciate. Do not. I have to go back and change the setting. Through a branch in the overseas countries, exemption is available. Yes, through a investment in subsidiary, joint associate, joint venture, or simple investment. Simple investment exemption available via the participation exemption. If through branch, then we have to go foreign permanent establishment exemption. And if through the investment like a subsidiary, associate, joint venture, or simple investment, then we have to go for the participation exemption. That is the previous session, that second exempt income. Non-resident person having PE in UE. Non-resident person having UE, like the Roshan real estate, they have the P in the UE. Fixed place P in UE or agency P. Agency means he will have their own setup in the UE, or he will make the collaboration with one of the real estate agent, and they will make some memorandum MOU signing, and that real estate agent will work for them in UE. So if the real estate work only for the Roshan real estate, then it will be dependent agent. And if the UE agent, he work for other client also, and as well as for them also, then this will not be dependent agent. This is the independent agent. Okay, now the service fee, if you are giving the now the service fee, you are giving the service in another country. Okay, the service fee is the broader definition. The service fee, your employees are going to in another country and they are working over there. As of now, we are discussing the in UAE. So let's say one company in Saudi and they come from Saudi and work here and do some project, and like the auditors, like the auditor or the any consultant or the professional services, they will come here, their employee, they will send from Saudi employee, they will come here and they will work here, they do the assignment and they will go back. This is the service PE. There is a digital PE, there is a virtual PE. This is a broader concept here, like the Netflix are operating in worldwide, so they call the digital PE. So there is a taxation on Netflix also. If they have presence in worldwide income, they're saying, okay, you have to register in that country and pay the tax on the user that is from that country in using your services. That is a digital PE, virtual PE. So there is a broader concept on that also. But anyhow, this is not our main topic. The construction PE in UAE that we already discussed in the expo scenario. If there is a different terms and condition, we are not going to discuss. The PE is not our the main topic today. Let's move to the next. I'm not sure I can raise. I appreciate if you avoid this writing because it will create disturbance also. No, I'm not sure. Okay, anyhow, let's move to the same. Okay, now the next, this we already covered, so let's move to the next. Here, now we are going to understand this. Non-resident person are having nexus in UAE. Juridical non-resident person. We already seen the Roshan real estate having immovable property in UAE. Non-resident person are having UAE source income, the Amir Khan itself. Okay. So we understand if the Roshan real estate, it will be PE. If the Amir Khan media production house, this is not his core income generating activity, he will take the property, he will have the nexus. The nexus word is connected with the with connection. Like the property is one of the example. They will have the vending machine. They will have the vending machine. So that also will come under the nexus. So this is the connection. Definition is a broader that we will cover in later on. Let's see. Only withholding tax apply to income by UAE resident companies. Let's, because I'm trying to come to the main topic today. Okay, UAE resident taxable person, UAE source income. See that tax is the one thing. Along with that, you have to. I'm trying concept also, because once you understand the concept also, things will be fine. Okay, UAE resident person, UAE source income, non UAE source income. UAE resident person will, we already seen they have the UAE source income as well as non-UAE source income, both within the scope of the UAE city. Within the scope of the UAE city. Okay. Now non-UAE source income, how it will become? Having the investment in shares or securities in foreign jurisdiction. Anyhow, because non-source income, many way they will have. So this is just a concept that will be helpful for further learning point of view. Now UAE resident having presence of branch in a foreign jurisdiction. UAE resident person have branch in foreign jurisdiction. We understand the concept, but I'm just again streamlining the our understanding. Election is made for the foreign permanent establishment under Article 2 of the city law, and this election is irrevocable. This election is not irrevocable. This election is not irrevocable, means revocable can, so means every year we can make this election. So now the participation exemption will be subject to applicable condition that we already seen, the 9%. If the foreign country, if the tax is more than equal to 9%, then we can go for the exemption. Now we will see, okay, if we made the election, what will be the both income and associated expenditure are not taken into consideration in the UAE computation if we are making the election. This is the meaning of the election. Here I highlighted in yellow, not taken. Okay. Acknowledgement required from the foreign permanent establishment country that sufficient taxation in the foreign country. This is what we're saying. We need the one acknowledgement. The tax rate in the foreign jurisdiction is a 9% or more. So net income exemption. Okay. Net income is the exemption. If we made the election, means whole income will be exempt. Now, no, if income is exempt, so no foreign tax credit relief. If income is not taxable, there will be no foreign tax credit relief also. Same election for all foreign permanent establishments will apply. We already understand previously, if we have 10 branches, we will apply on all branches. We cannot say, okay, these 5 are profitable, we will apply on that, and these 5 is loss making, we will not apply on that. No, either we make on all or either none. But exception is there if the tax rate is less than 9%, that will not come under this election. All foreign branches are separate. All foreign permanent establishment or branches are separate. This is another concept. Or separate means we have to keep the record of all the foreign branches. What that means, how much the income or expenditure are coming from the foreign branches, and on that you have to calculate. Now the next is the no election made. If no election, both income and associated expenses taken into account in the UAE, which means if no election is subject to UAE city taxation, we will add income and less expenses from the UAE city. Double taxation relief will be available, which is a lower of UAE city on foreign income and the foreign tax on the foreign income. FI is a foreign income. Let's move to the next. Okay, let's do this exercise to. Now we're going to understand through this example. This is the FTA example. Okay, the KLLC is a UAE resident corporation, means UAE company. Let me take here the UAE resident company. In addition to main business operation being conducted in UAE, okay, KLLC have a foreign branches, foreign permanent establishment, where in 3 countries. 3 countries mean 3 different jurisdiction, 3 different tax authorities, 3 different tax rate. Country A, country B, and country C. After applying all relevant adjustments, means after the K taxable income for the tax period was 15.6 million, which means foreign income and expenditure already added over here. This is the after. This includes the following income and expenditure of, what is it? Include. Below expenses, already adjustment is done in this. So this is the net figure. Okay, foreign permanent establishment. Okay, now we have to see. Let us do this exercise. This is the expenses. So let's do this exercise. If we have the, how much the income is the 15.6. These are the three. Here I'm gonna make the total. So total means, so 15. So guys, be ready, and now you have to do the calculation for that. So now would you please apply the foreign tax exemption over here, foreign permanent establishment exemption over here. Guys, would you please? So here tax is 5%. I'm talking about the foreign jurisdiction. Here is a 9% or more, and here is a 9% or more. So please confirm, can we apply the foreign tax foreign permanent establishment exemption? Guys, quickly, can we apply here or no? Guys, please confirm, can we apply here foreign tax exemption or no? One, on all branches, these are separate branches. We have to review each branch separately. Each branch we have to consider separately. Jurisdiction. Okay, guys, mostly is saying C will not be. Yes, because their tax rate is less than 5%. So we can make the election under election. A and B will fall under the election. A and B will fall under the election, and C will not fall the election. But now this is KLC decide to make the election not to take into account the income and expenses from the foreign permanent establishment. While foreign permanent establishment in country A and B are subject to similar taxes in a character of the corporate tax in a rate of more than 9%. See the 9%. Earlier, I was just trying to check this point. Okay. The corporate tax rate in the C is 5%. So the C will not be fall under the exemption. This is the below the corporate tax threshold, means the income and expenditure related to KLC foreign establishment in country C will remain part of the UECT. Exemption does not apply on the C. Other is applicable. Guys, you understand this point? Let's move to the next decision point. So this is the what in the beginning I said. In the beginning, what I said is good to make the election or when it is profitable, or is good to make the election when the is a loss. So this is the decision point. Let's understand the example election under profit position. When we have the profit from the branches. Foreign branches, if giving us the profit, excluding foreign branches, UE taxable income is 1 million and the foreign profit is 200 at the rate of 10% in the foreign country. The same condition is more than 9%. Taxable income is a 900. Let's see if we make the election. So what will be happen? If we make the election, we will not bring this 200 into our city computation, right? So how much will be tax? How much will be tax? Now we gonna see the both side, whether it's good to make the election when we have the profit or no. So how we calculate the tax income is about 1 million after all the adjustment. The first 375,000 is a zero rated and balance. So our UE tax is 56,250. So now election is made as income not added to, no relief. So in this scenario, we opt for the election, no relief is available. But just in case if we not make the election, in case here we said election is made, here we did not make the election, which means let's see. Taxable income is 1.2 million. How? This is the UE and this is the foreign. Add together 1.2 million. The first 375,000 is a zero rated. Next is 825,000 at the rate of 9%. So tax is 74,000. So now we have to see the calculation of the foreign tax. Less foreign tax credit relief lower off from the point A and B. So just for understanding, here we paid the only up to here, how much the tax we are paying and how much tax we are paying here. Just as the understanding, but still this is not completed. Now let's see the foreign tax credit, less foreign tax credit relief lower of A and B. What is the A and B? UE tax on foreign income. UE tax on foreign income, how it will be? First, we have to calculate the effective tax rate. First, we have to calculate the effective tax rate. So what is the effective tax rate? Guys, quickly give me the effective tax rate. Guys, please calculate the effective tax rate. So what we have to do, we have to, here is the tax is 74,000. Tax is 74 to 50. And what will become 1.2 million. So I'll take your example into 100. What is the effective tax rate? What is effective tax rate? It is the same, 6.19, guys, quickly. So I'm not gonna calculate, I'm just taking your figure, 6.18. Guys, double check if it's confirm. So this is our effective tax rate. Okay, effective tax rate is the 6.18. So now we have to calculate the effective tax rate. Apply this tax rate on this. Apply this tax rate. This one into effective tax rate. Apply this. So what is the answer? What is the answer? Would you please? What is the answer? Apply this effective tax rate on the foreign income, that is the 200,000. Okay, guys, this is the answer will be here. Okay, this formula is also written. UE tax, UE corporate tax, UE corporate tax payable, you can consider, and taxable income divided by taxable income into foreign taxable income. The foreign taxable, if we multiply, so this income is coming over here. So now foreign tax. Foreign tax, we said here that 10%. So 10%, it is the 20,000. It is the 20,000. So which means this is the option A 12,000 and option B is 20,000. Which one is the lower of? Which one is the lower of? So 12,000 is the lower of. So minus 12,000. So answer will be 74,000. 74,000 minus 12,000. What will be answer? This minus this. This is the answer. Guys, so this is the answer. Now you guys let me know. You guys let me know. So what is the better, to make the election or not make the election? While making the election, we have the profit tax payable 56,000. And here, after doing all this calculation, if we not make the election, 61,000. Earlier, now this may, you have to do this calculation and understand. This may vary based on each organization. Don't take as a thumb rule, take the concept. Take the concept and apply on that specific scenario. Okay, now next, in case of loss. In case of loss. Earlier we seen the profit and now the loss. Exclude UAE income 1 million. Foreign branches is a 200, same at the rate of 9% tax in the foreign country. The next is the election is made. If election is made, so we will see under election we will ignore everything, and the same calculation we will do. If no election, taxable income will be, because here is the loss. Here is the loss. 1 million minus 200 will be 800. 1 million, it will be 800. Now let's calculate that. Let's calculate that if here the same 56,000 from previous one, we have it. And here we will calculate the 375,000 is zero rated and balance is a 9%, 38,000. So here in previous we seen the 56,000 250, right? Because here will be tax on the 1 million. So tax is 56,000. So here if we do the same calculation, foreign tax credit relief, lower of mean option A on UE tax on the foreign income, B foreign taxation on the foreign income. There is no foreign income. There will be a foreign tax also zero and UE tax also zero, right? In case of loss, there will be no this calculation. Both will be 0, 0. If 0, 0, lower if the foreign tax is loss is a lower. Who will take this? So this is the our tax payable. If this is the our tax payable, if this is the our tax payable, so what is the decision point? What is the decision point? Guys, quickly. Under loss, you've seen the scenario. Now let me know. Okay, hope you understand this concept very well. So here, if you wish to read this Ministerial Decision 116, Article 13 of Foreign Permanent Establishments, tax losses where a taxable person has utilized a tax losses incurred in a foreign permanent establishment of the same tax period. The tax losses must be fully offset by the taxable person from the permanent establishment in the subsequent tax period. This is the another point. Are the tax losses before either of the following? Tax losses can apply to foreign permanent establishment exemption provided. So now here another point that is the very interesting point for the understanding point of view. Let's read the first. The taxable income can elect to apply the foreign permanent establishment exemption provided in Article 24 of the city law. Any income arising upon or following the incorporation of the permanent establishment can benefit from the provision of 23. Here is another important point. What he's saying, you can make the election, you can opt for that, because here they said is irrevocable. Oh, sorry, revocable. Mean every year you can make the election, but if every year make the election, but that doesn't mean if the let's say the branches will take the same concept, branch A, B, and C. Here branch C is the loss. Let's say the 500 or 5,000. This is the loss. This is the year one. This is the year one. Here maybe the profit, we can make the understanding of the profit, and here is also profit. Where it is in case of loss, so they will have the benefit. What is mean? Any foreign permanent establishment tax losses where a foreign permanent has utilized a tax losses incurred in a foreign permanent establishment of the same taxable person. Of the same taxable person. What that mean if, let's say, in the year one, we did not make the election? If, or let's say in the year one, we make the election, here also loss, here is also loss, here is also loss. I'm just taking the all loss first. This for understanding purpose. So let's say we have the loss of year one is the loss. And year one is the profit. The loss mean he taken the advantage. Loss mean he taken the advantage. Guys, you understand the losses mean they taking the advantage. So how much the advantage? Due to the losses, he have to pay 56,000. But how much he paid? 38,000. What is the benefit he taken? What is the benefit he taken? 56, 250 minus 38, 250. This is 18,000. This is 18K they taken the benefit. So in this year, they said no election. No election, and based on no election, because it's a losses, so he take the advantage of, he enjoy the tax benefit of 18,000. And next, this is the, let's say the year one. This is the year one. In the year two, if he have the profit, and we will see if the profit, so we can make the election because this is not the revocable. This is not the irrevocable. So next year we can make the election. Yes, we can make the election. The year one, no election. Year two, election. But they're saying you can make the election, and while making the election, you can enjoy the benefit, but you have to first compensate this benefit that you already covered. First, you have to compensate this benefit, which means up to this amount to be reversed if your the benefit from the incorporating the profit, you have to do the calculation and see if you're because we're gonna do our calculation. Based on that, we'll take the decision, we'll make election or not. They said next year you can make the election. First year, no election, and the second year, make the election. But the benefit that you enjoy in the previous year where no election, that you have to make taxable in the current year. Just simple, if I'm saying this much amount will be taxable, because this is, you have to compensate this amount first. This is the what it mean. The article form where the taxable person has utilized tax losses, incurred a permanent establishment of the same taxable person, that loss may be fully offset by the taxable person in the subsequent taxable period, in the year two. Guys, you understand? If let's say in year two, if you not make the election, you have the profit and you have to pay the additional tax of, let's say, the 30,000. If you not make the election in year two, you have to pay the 30,000. So saying, okay, from 30,000, that is the benefit, minus 18,000, and then you make the taxable in this year 18,000 with the information from the previous year. And then you can opt for the election and pay the tax on this 18,000. The balance 12,000 still you can enjoy. Guys, you understand this point or no? Guys, quickly. So let's say if the simple term we are saying this is the irrevocable, if you make the election, this is the irrevocable, okay? So ultimate the understanding at the bottom line, it will be remain same. They saying it's make every year or not make every year. But if you taken the advantage, that you have to compensate in the subsequent year. Why they've said this is the revocable? Due to many reasons. Due to many reasons, they kept open, but they ensured you cannot take the advantage of the UAE corporate tax. The GAR rule will be applied. The GAR rule, if your main objective to opt for the election on and off to take the city, then they say you have to adjust the previous benefit, then you can change your election. Okay, now the next point is the out of scope. Okay, so out of scope, what are the income is out of scope? The natural person, the salaries, wages, real estate, and the personal investment is the out of scope. Which one is the resident as well as non-resident? Okay, so doing natural person doing business and revenue is less than 1 million, less than 1 million. What is saying out of scope the personal capacity. Personal capacity, we discussed the salaries, wages, the personal here. This is another point and very critical point. Personal capacity. You have to understand the personal capacity because upcoming topic. This is very important where we have to understand the personal capacity as a business. As a business, the implication will be different. As a business means the same natural person doing the business via trade lessons, Guys, that's what I'm saying, the personal. If the personal capacity he is doing, this is the out of scope salaries plus wages. Then RE, real estate income. Then the personal investment, share securities. These are the out of scope. But under business, if your revenue is less than 1 million, then it will be out of scope. Hope you understand the difference between both of them. Both are out of scope, but the difference, guys, you understand the difference. This is the very critical point. Ministerial decision 49. Ministerial decision 49 on this point. I received last week the call from one of my same circles. He's also working as a consultant. So he was debating on the same point on that. He's saying the tax law is saying, city law is saying something. This is the out of scope. But this part is missing. This part is missing. I told him, check the business income. What are the regulation of the business income? I give him a couple of reference also, but still, see, the law in one point is saying something, but next clause may be affecting that first point. So the law is not only the reading the first point, you will apply and do the working. If you are familiar, full law means the city law, ministerial decision, cabinet decision, FTA decision, tax procedure law, cabinet decision, ministerial decision, cabinet decision, FTA decision, the tax procedure law. So all these 5 points, 1, 2, 3, 4, 5. Criminal penalties, it's available over here. Under tax procedure law, it's not available in city law, ministerial law, FTA, it's available over here. So if you are aware all the things, then you can apply the appropriate way. Anyhow, the concept is, these are the out of scope, unincorporated partnership, businesses. Here again, this is the next critical point, unincorporated businesses. Unincorporated business, and they are transparent. Transparent look-through effect. Look-through effect means the owner is liable for the city corporate tax. Business is not liable. This is the transparent. Not applied for the OPEC. If they're not applied for the OPEC, we will understand in the next session. This is our critical main topic. Next is the family foundation. Family foundation by default will be juridical person, but applied to be OPEC, applied to be unincorporated partnership, applied to be unincorporated partnership, not OPEC, sorry, unincorporated partnership. Then it will be out of scope. Then this is the fourth point that we are discussing today. Our learning is today. We learned this point. How we learn foreign permanent establishment. If election is made, then it will be out of scope. Guys, this topic, hope you understand and enjoy. Give me quickly response. We will take another 20 minutes to cover the balance portion. Hope this point is understand. Okay. So here I added this ministerial decision. You can, the reference is there. You can go and study also. Let's see the next, our topic today is the international. Okay. International aircraft, this is the fourth point. This is the fourth point of the exempt income. International aircraft or shipping income. So what is, how it will be appearing in the corporate tax return? I'm correlating each topic with the corporate tax return. I'm trying to align with the corporate tax, our training. You will understand the each topic and one point of the corporate tax return will be covered. You can go and do the needful and file the, while filing, this point will be covered. So now this part is the international aircraft shipping, international transportation, we might say over here also. Did the taxable person derive income from the operation of the aircraft or ship in the international transportation, which is exempt from the corporate tax? Yes or no? This is for the non-resident person. This will be for the non-resident person because how it will work, we will understand, but this is non-resident person. Did the taxable person drive? Yes. Okay. In case of yes, this information will be appear. In which country is the taxable person resident? Let's say the UAE. Income derived in UAE from the operation or ship or aircraft. So here will be for if you are considering from the here in which country is the taxable person is resident. If we taking the non-resident person, so we might say the UK. Right? Or might say the KSA. Or might say the Europe, Canada, India. So this is from the non-resident perspective. Okay. Because under certain scenario, maybe the person is, because we seen today the non-resident person also is taxable. So we will see on each scenario is the non-resident person under which condition, but to understand this concept for non-resident point of view, did the taxable person derived income from the operation of aircraft and shipment international transportation? This is the international transportation, which is exempt from the corporate tax. Okay. Income derived from because income derived in the UAE from the operating ships and the aircraft. This is what he's saying, income derived in the UAE. The UK company, his drive income in the UAE from operating ships and aircraft. Expenditure for the same. Hope you understand this point is very critical and this is applicable on the non-resident person also. Okay, So this is one of the only the one point, and we have to give the detail. But let's give you the example. Just one more point. I just pop up in my mind. The foreign branches or the foreign permanent establishment income also we have to keep both. What both? Income and expenditure. Income and expenditure. You have to keep the track record or the working of the foreign branches that you are gonna take the if you not make the election, you will add over here and then do the competition. You will have to keep all the information, and the return you have to upload the detail also. Okay, so let's move to the next. So this is the point, and now we will understand what is this, the exempt income from the operating aircraft and shipment. Here the aircraft, the another point you have to understand, aircraft means which transport? Air, right? The second is the ship, the sea, which means the road is not covered over here. Road is not covered. Only air, sea, the road is not covered. Right? Road is not covered in this topic. This and this only covered. Okay. The road is not covered, not subject to corporate tax as long as the non-resident person, again, I mentioned the UK. So this option is for non-resident who's generating UE source income, who's generating the revenue or income from the UE. Okay. So they might be subject to city registration. We will see under the each company what are their scenario. They might be subject to city and they have to submit the return, but they will use this option as a non-resident person. As a non-resident person. International transportation of the passenger, livestock, mail, parcel, merchandise, or goods by air or by sea. Here by air or by sea. Road is not there. Or leasing or chartering aircraft or ships used in international transportation, right? He's doing any of the activity, either this one or this one, or leasing the equipment of which are integral to the seaworthiness of the shipment. Okay. He's doing this transport equipment only. Airworthiness of the aircraft used in the international transportation. The main concept is this international transportation. The exemption only apply if similar provision are applied to the UE resident person conducting the same activity in the country or territory in which the non-resident person is a resident. What does that mean? Mean if Emirates airline giving the benefit to the British airline, so the UK jurisdiction, they must give the benefit to Emirates airline also on the same basis. They will not tax on the Emirates airline in the UK, as UE will not give. This is the same as the similar provision are applied to the UE resident, reciprocal basis, basis. The same benefit other country giving to UE business, yes, UE giving the same benefit is available. There must be a reciprocal exemption offered by the relevant foreign jurisdiction. Why written they're taking this information? Because they have to ensure the other country giving the benefit or no. That's why they are saying add the detail, you provide this detail, they were gonna cross check the exemption is available for the UE businesses in the foreign country or no. There must be a reciprocal exemption offered by the relevant foreign jurisdiction. A reciprocal exemption means this is the same actually. means the UAE company carrying out a similar business in the foreign country would be exempt from any of the tax similar to corporate tax in that foreign country. Any point in this regard? Any point in this regard? Now today is the third topic. I'll try to cover up that third topic also. Hope so far the previous point is covered. Guys, quickly, are you there? Are you there? Okay, so next is our topic is the related party and the connected person. Related party and the connected person. And how we will report this related party and connected person activity in the corporate tax return. What are the impacts? We will not discuss the transfer pricing, but due to the related party and connected person, we have to report or we have to make the adjustment. We have to give all the transaction that we do with the related party and the connected person. The connected person is a broader definition that cover the related party also. Okay. But connected person is a broader definition. Under that, related party also fall. But we will see. Whatever the transaction we are doing with the related party or connected person, so based on that, what are the effect that we have to report in the CTE return, and how we gonna report that? That we will learn today. So now let's see the return. If the return, what are the point is shown? Under return, what there is any transaction with the related party? If we say no, then the further all the return implication will not be open. Further, all the return implication will not be open. But if we say yes, the further information we have to provide. Now, addition as a result of adjustment to the transaction which is not arm's length. I'm going to give you the example. We will have the detailed example. Anyhow, let's say if we, let's say this common example, if we in the same company, the owner give the one of the position to his wife, and his wife is working as a, let's say, any managerial position. Although this is so now the wife is the related party or connected person, any one of them, just as a broader concept. Just as a broader concept. Guys, would you please respond on that? So if a connected person, so now just take the understanding, the salary of the same executive position, in the market is, let's say, the 30K. Market value is 30K. But how much you pay is the 50K. Actual is 50, but market value is, so there is a difference of 20K. There's a 20K difference. So now they're saying, okay, in accounting, whatever you did, this is your call. But in tax accounting or in tax return, you have to make the adjustment of this 20K. You have to make the adjustment of 20K. So addition as a result of adjustment to the transaction which is not on arm length. So which means this 20K you have to add over here. Deduction as a result of adjustment to transactions which are not arm length. So on the similar way, there is a deduction also may be applied. Why? Transfer pricing, BEPS OECD model, BEPS OECD model, uh, base origin shifting. Base origin shifting means that, let's say, I'll give you the here also example. Here the thing, the deduction. Let's say the company A, I'll just give you the same concept. Company A is run by H. Company B is run by wife. This is the common understanding that mostly people are asking, we will do this, we will do this. So what happened here is income is more. If income is more in A, let's assume that here income is less. If income is less, so maybe less than 3 million. Let's make the scenario less than or equal to 3 million. So they are eligible for SBR. They are eligible for SBR. Here is the higher income, they will pay the 9% city. So what they did, they sold couple of transaction, they made the transaction with B. So on what they made? If let's say a product, you buy the product, your cost is the 100. Okay, your cost is 100. So how you gonna shift over there? How you gonna shift make the transfer or the profit from A to B? If your cost is 100, then you sold to B, if you make the 80. If you buy at 100 and sell at 80, okay, so what you did? As a result, your profit will be reduced. As a result, profit will be reduced. If the profit is reduced, so which means, so you made the transfer of how much? Maybe up to 1 million, or maybe up to 2 million, or maybe 2.5 million. If you did like that, just to manage the tax liability, you said you have the conversation with your wife, you open another company under his name, and you said, okay, we will keep on less than 3 million, and first 3 years we will have the benefit of the SBR. Just from here, just take the concept of the adjustment. Don't take the other way around, or you say, okay, this is a good idea, we'll apply on that. No, I'm not giving you that idea. I'm just saying, just take the concept, how it gonna adjustment will be recorded. So here the actual value of 2.5 million may be the 3 million, or maybe the 3.5 million. So here is the 1 million. What I'm saying, your cost is this, your cost is this, okay, but you're selling on this. So difference is 1 million. So what are you going to do that? Just to manage that, because to reduce your tax liability, this is the one of the activity that you did. So what they're saying, the normally you are selling to the customer is at 10% profit. So it will be, let's say the 3.5 is the cost. Now you have to take the another 10%. So this, which means 350 you gonna add over here. So total will be 3.5, let's say 350. Maybe the numeric figure is not correct. So now you have to take the difference. This difference will be 1 million. Here, the difference from here to here. Okay. $1 million, maybe 350. Guys, you understand the point over here? Anyhow, guys, quickly, please. You understand this adjustment you have to report over here. Deduction as a result of the adjustment to transaction which are not arm length. Okay. Here I give you the concept from one way, but if you reverse, let's say the same concept from the B point of view, so the deduction. So this will be considering from the deduction point of view. You have to see from other way around. So here we added over there. Deduction as a result of adjustment, this will be deduction point of view. From the other point of view, which is not arm length. Okay. So deduction means, so we have to calculate in the both side, and then we have to report over here. This the understanding we took just for understanding purpose. There is no real concern over there until unless the scenario was there. Okay, now let's see the next also. Were there any transaction with the related party? Now they are asking specifically. Here they did not ask this point. He said first you give the adjustment that you knows. Okay. Now he's saying give us the transaction. Were there any transaction with the related party in the current tax period? You have to report. In case no, fine. Now adjustment to gain in relation to asset or liability previously received from the related party at a non-arm length price. The same that we discussed, the 2.5 and 3.5, the difference, you understand the same concept, because this is our related party, our connected person also will be appearing. So you have to report that figure over here. Second is the adjustment to loss, gain as well as loss, both. Addition and deduction also, gain and loss, income and expense. They will ask both information separately. Next, the connected person, transaction with the related party, connected person. The same concept, you have to report adjustment as a result of payment or benefit. The word payment or benefit, we're going to understand the payment or benefit. What are these? So we have to report over there. Adjustment in relation to previously received from the related party, we have to report. Loss, we have to report. Here we have to give the detail of the related party and the connected person. Whatever the total, it will be appearing here. Their detail, their TRN, total expenditure, total number of employees. So all the detail we have to share with the FTA in the return. So guys, can we continue another 20 minutes, or is up to this you guys are here only 15 to 20 minutes? We will cover this topic later party. This will not take much time. Major part we already covered. because initial session was already taken the more time. Okay, bear with me. So related party, the natural person. So we have to understand. Guys, try to make your capacity now 20-30 minutes more also. Let's cover this topic because due to certain reason today time is out. I have to cover in the same timing. So just bear with me. Just bear with me. This will not take more time because major topic we already covered in written, we already understand. Let's cover quickly. Natural person, we have to see the natural person, the related party up to fourth degree relative, up to fourth degree relative. Okay, the up to fourth degree relative, natural person and the company. Okay, I'm just gonna. The related party can be natural person, but can be company also. Natural person up to 4 degree, we will see what is the 4 degree person and the partner. The person and the permanent establishment, partner and partner, maybe one person is from natural person, another is the permanent establishment. They are have the relation, or they are part of in permanent establishment. They are partner in permanent establishment. See, in one company they have multiple partners. Can be juridical person, can be natural person. If they are working together they are having the investment in one company, so they are the related party. Natural person and company. Here the definition is the natural person or the company more than 50% on in term of the company. In term of the company, you need to have the more than 50% juridical person. Juridical person. You need to have more than 50% shareholding on control, shares and control. 50% and the control related party. Okay, the same between the companies here, both are juridical person. Okay, same, the rule is same, 50% or more, they own the shares, they have the control. This normally most of us are familiar, so I'm just covering the quickly. Here the related party, the first is the fourth degree of kingship, the natural person, fourth degree kingship. The second, natural person and a juridical. This is the same previous diagram, but here in the better way you will understand. Two or more natural person related to related up to fourth degree of the kingship. Okay, like your what is the kingship? Means your father and your grandfather, same like you from your mother side, the relation, and same if you are from wife side, the same relation, your wife, mother, grandmother, grandfather, so this is the fourth degree. You have to calculate the consider the related party. Natural person and juridical person related by the ownership 50% or greater are control. If they have the control more than 50% in ownership, two or more juridical person related by ownership 50% or greater, or they have the control. Okay, here we understand natural person, juridical person will be same 50%. Two juridical person or more than two, also the 50% shareholding and the control. A person and its PE are the foreign PE. A person, if he have the permanent establishment exemption in the UAE, or is the foreign permanent establishment exemption. Permanent establishment or the foreign permanent establishment, they are also related party. Partner in the same unincorporated partnership. In one this is not juridical person, but you have more than two partners, so that is the unincorporated. Same like sole establishment, if the one person is running the business through the license, they call the sole establishment or sole proprietor. This is not the LLC. But if more than one person, they will say okay, sole unincorporated partnership. This is not juridical, this is not LLC. They will say more than two or more than two, they will say unincorporated partnership by agreement. Then the trust, the family trust, we discussed the trust, a trustee, founder, and settler. Okay, family trust, where here in the UAE concept is that if you own the property under your name by in case of the death So you are maybe non-Muslim, so the property belongs to you as per Sharia law, it will be split into your family. But if you wish to avoid the local regulation, then you may open the family trust, family foundation. This is a juridical person, but you also opt for the unincorporated partnership. But if you make the trust and keep the your property under the trust name, then Sharia law will not be applied. So here the control definition, the control exercise 50% or more voting right, the control definition with the voting right, okay? Determine composition of 50% or more of the board of directors. Determine composition of 50% more of the board of directors, then receive 50% more of the profit. This is the control definition, voting right, profit, significant influence over the conduct or affair of the another person. So if you are having the influence on the company operation or the PE or whatever the format we are discussing, then it will be subject to control. But the city law does not provide a clarification on how significant influence is interpreted, which means there is no guideline how you will ensure this is the influence on that person. What is the influence? And they force them to do it, the things in their wish, in their way, in their fashion, in their wish list. Up to a certain extent, they are following the parents. So parents are influencing them. Like the social media, I'm just giving you, this is not relevant, the social media influencer. They have the follower, if they post over there, so people will follow that product or that promotion. So influencer, the definition, in general term, you understand, but in terms of the company operation, you must have the significant influence on the operation of the company or voting rights. Again, the definition will be covered more than 50% or the profit. So that describe the control. Let's move to the next. Two or more natural person related to the fourth degree of kingship, including by adopting or the guardianship or 208. This would include the following. The first degree of the kingship and the affiliate include a natural person, parent, and the children, as well as the parent and the children of their spouses. This is the first degree. Second degree of the kingship and affiliation, additional, includes the natural person. Here, now see, the parents and children, grandparents and the grandchildren, and the sibling, brother, sister, as well as the grandparents and the grandchildren and sibling of their spouses. Like now here, if you just see the okay, the grandparents, the great grandparents, great grandchildren. So here in the same fashion, it will be calculated in the fourth degree, the connected person definition. And their first cousin is coming in the same way. In the first cousin, okay, fourth degree, kingship and affiliation, additional include a natural person, great grandparent. The word great is increasing. Where is that? Great nephew and his first cousin, as well as the great grandparents. Same the definition. Hope you understand the concept, the great. So this will be great, fourth degree up, fourth degree down, fourth degree left and right. If you watch from this point of view, you will understand the connected person definition. Each side, like from the up, from your parents, from left, you from your wife, and from down, from your children, okay, and from your wife, his relative, and his family downside. So you have to consider in that way. Okay, let's take this example quickly to refine our understanding. We will cover inshallah within a short time. Here's a couple of examples and then topic will be finished. Related party, control and connected person. Mr. B is the first cousin of Mr. C. Here, the Mr. C. And Mr. B owns 75% X UAE company. He owns this one. So now you have to, what we are checking, the relation. here more than 50%. So both are connected person. So if B is running this and this is his first cousin, so C and X is a connected person or no? A related party or no? Guys, quickly. Now the C is a connected person with X or no? A is the first cousin of C. Oh, sorry, B is the first cousin of C, and the same B is running is the company over here. So which means B have relation over here and B have relation over here. So same relation will be continue. Okay, the C, now the C on 20% shares of the company Y, less than 50%. But now let's see. A UAE company, she owns preferred share, which entitle C. C, this is a Mrs. Okay, female. She on preferred shares. The preferred share, which entitles 60% of voting rights. So which means it is 20%, but now it is the related party because 60% voting rights. Okay. In company Y. In company Y. She is also partner in UAE unincorporated partnership. Partner in unincorporated partnership P. The other partner in the partnership is a UAE company and the company is Z. If you take the example, so we already understand. So B and X, the 75% is the related party, and B and C, they are cousins. So which means they are cousins. So this and this will be related party. Accordingly, vice versa, this and this is related party. This and this related party, this and this related party, this and this related party. Why this is C? Due to this 60%. This is not applicable, but due to this is a related party. Now this is unincorporated partnership. She is also partner in unincorporated partnership P. This is the unincorporated partnership P. Okay. The other partner in the partnership in the UAE company Z. So this is the company Z. So which means if they are here partner and she is controlling effective, so they also be connected person or no? Here, if they're coming from here, this unincorporated partnership will be connected person for them. And from here, the same way, it will be connected person, it will be connected person. So all will be connected person. Let's see the answer. Mr. B and C are related party as they are the first cousin. Then related party, related to 4th degree of kingship. B and X are related party. Mr. B is a natural person who directly own more than 50%. X, that we understand, juridical person, and Mr. B is the connected person of company X because he is an owner of the company X. Here, B and X, B and X. See here, this is the, sorry, this is B and X. Okay. B and X are related party. B is a natural person who own or more than 50% in the X. Fine, that we understand 50% share. And B is a connected person of the company X because he is in the owner of the, okay. B, Mr. B and Y are related party. Why? This is the Y. How is Y? Because it's going, how is getting connected? B is going here. Then from here, it's going to here. And this is the 60%. If this is the related party, because this he is a cousin, so cousin is in the same definition. Our related party and is an individual who together with his related party and Mr. C control Y, both and A, B, C are connected person. Because Mr. C is the owner of the company, Y and B is a related party. B is the connected person of the Z. B, where is the B? B is the connected person of company Z. See, because this relation is getting established, so accordingly, this relation will go up to here also. Because they are related party. First degree. B is a related party of Mr. C, who is a partner in the unincorporated partnership Z. Due to C. B is a related party of Mr. C. Here, see, this is the first relation. Due to this relation, he will, wherever the C is a related party, B by default will be related party. Due to kingship, who is a partner in the same unincorporated partnership. Mr. C and X are related party. Mr. C is an individual who, together with his related party, Mr. B, Mr. C, here's the C, where's the C? Just wanna take another color. This is the C. Mr. C and X are related party. Fine, they are related party. And Mr. C is an individual together with related party, Mr. B, fine. And the control A. So from here, we think from here, relation is here. Then if relation is here, then this is also related party. And Mr. C is the connected person of Mr. X. Mr. C is the connected person of Mr. X. Due to this, because he is the related party of Mr. B, who owns the X. The word definition, the connected person also is appearing over here. Y together with the Mr. B, connected person X, Mr. C is the connected person of X. So ultimate, all our related party are connected person. Hope this concept is understand. I will not take more time. Here, I'll just gonna take this. Mr. C and Y are related party. Mr. C is the individual who directly control a juridical person, Y. And this is the FTA example you may find on the FTA guide also. Let's, due to the time, I'm just skipping some of the portion. But overall concept you understand or no? Quickly. You may take the screenshot and save it. You try to solve, it will be solved. Hope you understand this concept. Let's take the example now. These two examples, then we are covering this topic. Okay. So what is the title? Transaction with related party, consideration in excess of market value. The same we will discuss today. In return also, let's see this. A and B related party. A is a transferor on a yacht with a market value of 10 million. Now here he is selling yacht. Market value is 10 million. He sell the yacht to B. So this is the A, and this is the B. He sell the yacht. If we're selling the yachts, okay, how much the value? 10 million. The market value is, at the time of selling, his market value is 10 million. But it sell to be at the 15 million. This is same example where I said you have the cost is 2.5 million, but you sold to, okay, that was the opposite effect. You sold to 3.5 million. Just taken the same concept. Now here it sell the yacht to the B on the 15 million. So which means the sale value 15. So how much the excess? How much the excess? So this 5 is the excess. This we have to report in the city return. This we have to return in the city return. Later on, some adjustment will be there. in excess of the market value. Okay. In accounting, you recorded 15, but in city, you have to report this 15 million or 5 million. Okay, now for corporate tax purposes, seller A would not include the amount exceeding the market value. How much include? Will not exceeding the market value. What is exceeding? That is the 5 million. So which means he will record at city in 10 million. It would thus include 10 million in taxable income. Fine. As the recipient of the yacht, the company is the transferee. Company B is the transferee, need to consider the adjustment required for the transaction with the related party. Okay. So company B, he have to report this 5 million also, because he will say, okay, I paid the 15 million, even the market value is 10 million, but I paid the, he's saying, okay, the addition amount. So you have to report in the adjustment that we seen today, in the related party in the return, we have to report over there. Now, if we report here the second effect, what will be the second effect? He will say, okay, in the city calculation, if the Mr. B, he have the yachts, okay, 15 million, if he buy at the 15 million, if you buy at 15 million, but market value is at 10, so what is tax authority saying? Your depreciation will be counted from this value. Once the value of your asset, you make the depreciation. Let's say we already have some previous session. Let's say that 200 in the first year, it will be still the value is 13 million. Let's say the 2 million. Let's say the 2 million, just for understanding purpose. So 13 million still is more than. So year 2, again 2 million, again is 11 million. This is year 2. Year 3 is again 2 million is coming to 9. It's coming 9. So which means now this 1 million depreciation you can record. This 1 million depreciation you record in this city computation. But we already previously have very detailed topic of this discussion. You can go and check from the same. This is another concept. Okay. So this depreciation will not be deductible under city computation. Second, the city transaction related party, where we have to report in the return, on where we already seen that. Let's see the solution for this. Company B recognized the financial statement net book value as 15 million. The purchase price, this is the B. The market value is lower of 10 million. It would not be able to claim a deduction of depreciation. This is the same excess depreciation for any other change in value when the calculation of calculating is taxable income, until the net book value of the yacht reduced to the value that is equal or less than the 10 million. Hope this point you understand. Subsequently, company B determined that the yacht should be written down to 2 million. Company B written down 2 million. No deduction is available. Still, they say even you write down, still deduction. Okay, this is the deduction. In first year, we reported the 5 million. Now, maybe the next year you did this 2 million deduction, that also you have to report over there. So now in first year, we reported the 5, but there's a deduction for the same thing. So now net effect will remain 3 million. So we have to give this impact in the city computation or city return also. But here the depreciation point of view also, let's cover. No deduction is available for 3 million. 3 million loss for the purpose of the calculating is related to the change in value. The net book value as recognized transfer. Again, he's saying there will be no effect in the city computation due to this 3 million loss. Actually, this is 3, sorry. Here is a 2. Because 3 million is a loss. He make the write down value to 12 million. So 3 million is write down, write off. Company B later sell the yachts and realized event. Upon sale is realized. When the net book value is still 12 million, it would make an adjustment to increase its taxable income by 2 million. So now what is saying, here the concept, here the value is the net book value is a 12 million. Value is a 12 million. It sell the yacht when the net book value is still 1 million, it will be make an adjustment to increase in tax. Now he's saying he sold the yacht is the more than 12 million or 12 million. Okay. So where he's mentioning the still net book value is 12 million, it will be make an adjustment to increase in taxable income. So this 2 million now the previously we did not put in the city computation. Now we will make the city computation, which is the difference between the current net book value of 12 million and the market value of the original transfer. The intention in relation to overall effect of the adjustment is to give symmetrical result for corporate tax, ensure that a situation where the consideration paid by the transferee exceed market value and the transferee does not claim the deduction for the depreciation and the amortization or the other change in value where the net book value is more. So this depreciation concept, I think you already understand. So here in the year of sale, you have the 2 million that you're gonna taxable. Okay, you will record, but on the other side, you have the previously disallowed depreciation that you also gonna adjust against this 2 million. So in the year of sale, this 2 million is a taxable. So then this previously disallowed depreciation will be that we recorded as a deferred tax asset. So that will be now deductible, and the year of sale will be deductible. So guys, you hope remember the previous concept where we have the very step by step this exercise. Okay, so now you understand the related party concept also. So one more example. This is same return we already discussed. So here we have to report the benefits and the asset and liability previously from the related party adjustment. So these boxes we have to report while calculating the scenario. Okay, now the second example, the lower of. Earlier is the higher of, now is the lower of. Quickly, this similar to previous example, but the situation where the consideration is lower of the market value, a company B is related party, where the yacht is acquired, the transfer for 7 million and the market value is a 10 million. Now he paid the 7 million. He buy at 7 million, but actually market value is a 10 million. Was due to prayer. Okay, now let's quickly cover this example. Okay. company A must make an adjustment in the calculation of taxable income, included 3 million, being the difference between market value. So this company A, what is the adjustment? Now addition. You understand this addition because he sold at 7 million, but actually is it 10 million, which means he sold at less price. This means sold at a less price. If sold at a less price, so if they did the transaction with the related party, with the connected person, then this 3 million, this 3 million, this 3 million, where we have to report, where we have to report. Guys, quickly, where we have to report. This is the benefit, this is the benefit, adjustment as a relation of the payment or benefit provided to connected person, which are not market value, which is not market value. So you have to report. You have to report. This is the adjustment. So this is the adjustment we have to report to the in the return, and in city computation will compute while making the adjustment. Okay, I'll give you another scenario. While making this adjustment, what will happen? In accounting, you recorded at 7, but if you did this adjustment, it will be now 10. It will be now at 10. Why we are making the adjustment? Because we want to record at 10. So if you did this adjustment, it will be reported over 10, being the difference between the market value and the consideration paid by the B. At the time of transfer, company B recognized the net book value of the charge was 7 million, being the consideration paid in this financial statement. Company B, okay, at the time of transfer, company B recognized the net 7 million. Okay, now the B, because they record the less value. Company B subsequently revalued the yacht to the market value as a 10 million and recognized the unrealized gain of 3 million from the accounting purpose when calculating its taxable income for the tax period. So later on, they recognize as 10 million and 3 million, the unrecognized gain. Company B, whether or not it has made an election to use the realization basis, should exclude the whether or not it had made an election to use the realization basis. He's saying even he made the election or not, should exclude the unrealized gain of 3 million since such amount already being recognized company A. So if he also include in his calculation city computation, this will be double tax. This will be double tax. This will be double tax. So they will not do because it's already done by the A. So he will not include the effect already taken at the one side. Here he will not take. In future, the company B sell the yacht for 11 million and make a gain of 1 million. Then taxable income for the company B therefore will be 1 million. Because 3 million already tax here. Guys, you understand the point? Payment or benefit to connected person. The payment or benefit by taxable person to its connected person shall be deducted only. See here, this written this part. Payment and benefit. This we have to report. If payment or benefit provided by taxable person to its connected person shall be deductible only it to the extent the payment or benefit correspond to the market value of the service or benefit otherwise provided by the connected person incurred wholly or exclusively for the purpose of the person. Connected person include natural person who directly or indirectly own or control a company, director or officer of the company, related party, any of the person referred to the above. So here we also have to see in case we given the excess benefit or the payment, that also we have to report in the corporate tax return. The above rule will not apply. Above rule does not apply to any of the following: a public traded company on recognized exchange, stock listed exchange. This rule will not apply. There you already have the wife, brother, connected person. This rule will not be applied. Taxable person subject to regulatory oversight, qualifying public benefit entity, any person determined not by the minister. So here we will not apply this rule, payment and benefit. But apart from that, we will. But as long as this SME sector, yes, you will apply all these rules. Anyhow, guys, this is the, I believe, transfer pricing. There is no concept of transfer pricing, but we are doing this adjustment due to unfair, because the transaction are not at an arm length. That's why we are doing that. So natural person T is a natural person T business through a sole establishment. Here is the sole establishment. In UAE, Mr. T is registered corporate tax with the FTA. Fine, after meeting all the conditions. For the tax purpose ending 31st December, Mr. T withdraw 200 from the business and recorded in his personal business account and annual salary cost. So sole proprietor, the word sole proprietor. So from the sole proprietor, he cannot take the salary. Mr. T is running a sole establishment, no deduction is allowed. For 200, as Mr. C and business are the one. LLC company is allowed, sole establishment is not allowed. LLC, if a company is a LLC, then it's allowed. But currently, sole establishment not allowed. Salary. A natural person M work for the company based in the UAE. Mr. M hold a senior management position in the company and play a critical role in day-to-day operation. In addition to his employment responsibility, he is a member of board of director. Okay. As an employee, Mr. H receive a market rate salary for his exclusive role, which determined by his employment contract and is subject to applicable employment law. As a board member of the company, CH also receive fees from the attending board meeting. Here, the Mr. B salary received in the nature of the variance salary is not subject to tax. Here, the definition, this will be out of scope. Okay. In addition, the remuneration received Mr. M in their capacity as a board of director in the circumstances as set out above, which would be typically considered a wage in the same way as an employee salary is not subject to corporate tax. Here we think the board of director also getting some remuneration for attending the board of meeting, that also will be part of the salary. So thank you guys. Today we are ending up here. So we covered the most of the topic, and the transfer pricing is there is no point on transfer pricing, just the understanding purpose. We will see you later on once we reach on that topic. Guys, you have any question or anything else that you want to discuss, or apart from that, thank you very much, and you guys may leave also. Thank you. Today we spent 1 hour extra. Thank you for your patience and bear with me.